History repeats itself, and by studying the cycles of the past, we can better prepare for the future. Among today's geopolitical risks, the situation in the Middle East bears a striking resemblance to the era surrounding the 1970s oil shocks. Today, I'd like to propose an investment strategy that navigates this complex web of inflation, interest rates, and Middle Eastern geopolitical volatility. In the immediate aftermath of World War II and the Korean War, the US economy experienced significant inflationary fluctuations. Following that, between 1955 and 1965, both inflation and interest rates remained well below 5%. In fact, for a substantial period, the economy enjoyed a prolonged era of low inflation and low interest rates, hovering under 2%. This era is highly reminiscent of the low interest, low inflation environment we experienced in the 2000s, as well as the initial, mild economic conditions following the 2020 pandemic. However, after 1965, inflation and interest rates began to steadily climb, and with the onset of the 1970s oil shocks, we saw a massive explosion in macroeconomic volatility. In reality, the period from the late 1960s to the late 1980s can be defined as an era of structural high inflation and high interest rates marked by extreme volatility. Looking back at that era, and even up until the 2008 global financial crisis, the primary concern of the market was how to keep inflation under control. Taming inflation was the absolute main objective of central bank monetary policy. Today, we might just be walking down a path eerily similar to the late 1960s. A series of escalating events, from potential US and Israeli strikes on Iran, to Iran's retaliation across the Middle East, and the looming threat of a blockade in the Strait of Hormuz, forces us to seriously consider the possibility of a 21st century oil shock. An oil shock triggers severe supply and demand disruptions due to surging raw material prices, ultimately leading to an economic recession. As you can see on the chart, the shaded areas represent these periods of recession. A recession naturally causes demand destruction, leading to a temporary drop in inflation and subsequent interest rate cuts to stimulate the economy. However, due to persistently high oil prices, inflation quickly surges back up. This vicious repeating pattern of steep drops and sharp spikes is clearly illustrated in the data. So, let's summarize. In an environment characterized by heightened geopolitical risks, sticky inflation, and high interest rates, what investment strategies should we employ? First and foremost, you should look towards blue chip and value stocks that demonstrate stable, consistent earnings, particularly in the financial and energy sectors. In a high interest rate regime, companies with high debt ratios are exposed to significant risk. Therefore, focusing on companies with robust cash flow and reliable earnings is critical. Interestingly, within the big tech space, there are certain AI-driven companies capable of generating steady revenues, even amidst geopolitical turmoil. These companies have matured to the point where they should be evaluated as stable blue chips, rather than mere speculative growth stocks. Next is the defense sector. Beyond the traditional US defense contractors, pay close attention to European firms, as well as companies from South Korea, which is rapidly emerging as a global defense powerhouse. Major manufacturing nations are no longer relying solely on US weapon systems. They are actively researching, developing, and mass-producing their own arsenals to strengthen their independent security capabilities. This shifting dynamic is a crucial factor to keep in mind when selecting defense stocks and ETFs. Lastly, while the US stock market is heavily weighted towards growth stocks, the Canadian stock market is heavily concentrated in the financial and energy sectors. This gives the Canadian market a highly stable, blue-chip factor profile. Therefore, blending US index tracking ETFs with Canadian index tracking ETFs can be an exceptionally resilient strategy. This has been the Kairos. Please like, subscribe, and hit the notification bell so you never miss out on our latest macroeconomic insights. Thank you for watching.